Well, thank you everyone for joining us again for a very exciting podcast today with a woman I have a lot of respect for, Anjou Martinez. She has been a partner with us here at REAP, and so we've been able to see firsthand how fabulously she manages her business and her investors. And so, we started, or I started, empowered investing with leading ladies because what I found is that in the world of real estate, I believe the percentage it was 3% of commercial real estate investors are women. And so we want to increase that number. And we're hoping that one way to do that is to share these awesome stories of these great women who've found success in commercial real estate investing. So, as I said, today we have with us Anjou Martinez. She and I've known each other a couple years, I guess a little over a few years. And
Yes.
we met at a real estate event, which is where many of us meet. And so I wanted to start, Anjou, by welcoming you to the podcast, and happy to have you here today.
Yeah, super excited to just share this afternoon with you. Looking forward to it. Again, thank you for having me.
Wonderful, wonderful. Well, Anjou, I know a lot about your background, but I want the listening audience to hear more about who is Anjou. Like, where were you born? Where did you grow up? What was family life like for you as a young person? And then we'll go into more of the career stuff.
Sure. So I grew up in the Philippines, Manila, Philippines, but I wasn't born there. I was born in Saudi Arabia, then grew up in New Jersey. So that's where I went to school, had kids, and finally moved to Houston, Texas about 4 years ago. My background, I was an accountant, chief financial officer, controller for $20 million to $600 million top line, right? Revenues of companies. And that's in different sectors, healthcare, logistics. I did media and events as well. One time working in New York City, for about 2 years. So it was the typical corporate role. I did very well at it just because that was my background, that was my education as well. But at one point, I figured that there's got to be something more, right? Especially I'm a mom of three. My kids, so I have a daughter and then two boys. The oldest one, Bella, she's now 16. So now we're shopping for colleges. And then two boys, age 12, and then the youngest one's turning 6 next week. So my hands are full, and I've always looked for opportunities where I could grow my wealth and our family's wealth without putting in so much of time.
Yeah, I think that's phenomenal. I think one of the things we have in common is our corporate world experience. So, I was in banking for 20 years. And the first bit of that, I still remember, after our first daughter, Victoria, was born, leaving the office as fast as I could to get home. And luckily, we had a live in nanny that helped quite a bit. And then I had an opportunity to work from home. And so I took that opportunity for the same reasons you did. I wanted to be able to go to the school events, if they had a performance or they had an award ceremony, I wanted them to know that I was there. And so, that progressed into where eventually Jacob sold his software business, and we moved to San Antonio and then started working together in real estate. So I understand completely. It's just being with your kids, being able to influence your kids, because there's so much today that can be an influence, good or bad, with kids. And so I applaud you for taking that leap from kind of that comfortable corporate world into a world where you can take control. So
Absolutely.
congrats.
Thank you.
Yeah.
I think most of us have that, right? Like just that inkling of, there's got to be something better, or there's got to be something more. And back then, when at least we were working, right? We didn't have Zoom. I was commuting 4 hours 2 hours one way to Manhattan from New Jersey, and then 2 hours back. And because that's because I had a team. Remote working wasn't really an option back then, at least for the role I had, since I had a huge responsibility. And I think now it's shifted, but definitely back then, that's the same sentiments I had. I wanted to make sure I was there if I need to drop off someone, or if someone's sick, right? Because it's usually me that would have to take, half a day off. And then of course I can't just go back into school the following day. So I wanted that flexibility. I wanted more control of my time, especially because with our children, right? When they think of love, it's not just love. Sometimes they spell it with time. There's so
Yeah.
much time. And so I figured, you know what? I'll look outside, look at other options and perhaps see something better that I could still use my skill sets, but also still be able to, provide for my family and just build something more long term.
Sure. I completely agree. And the other thing when I was in banking, I learned about investments, but I learned about stocks and bonds and treasury bills and zero coupon bonds, the things that we were talking to our clients about, but I knew nothing about alternative investments.
Mhm.
So, how about you? Where did you start your investing journey prior to multifamily?
Yeah, prior to multifamily, I think most corporate people would still be investing, let's say in a 401k plan or
Yes.
an IRA. So I had that going since I was in my early 20s. But on the alternative investing, I started real estate, I think when I was 25. I read the book Rich Dad Poor Dad by Robert Kiyosaki. And he talked about, hey, you know what? You need to start not just working, exchanging my time for dollars, but start somehow investing. And so within, I would say 6 months, we bought our first property as a triplex. We lived in one unit, rented the other two, and we kept that for more than 15 years. So really, my daughter grew up there for, a few years before we upgraded to the next investment house. We were always just moving and investing. I didn't even look at multifamily until we moved to Houston because in New Jersey, like I thought these large apartment communities are owned by institutional investors, like banks, pension funds. I didn't realize that people like us, people that have, maybe like $50,000, $100,000 could be investing in these deals. So I didn't really look at multifamily until later on, about just 4 years ago.
Great. So really you started in a maybe small multifamily, kind of closer to single family, I guess, investing. And what did you find about your time commitment? Did you spend a lot of time with the tenants and fixing things, or how was that for you?
Absolutely. So yeah, we had some real estate, but then they were on the single family side, right? Because they're below 4 units, and the maximum we had was a triplex, and then some other single family homes. And so my husband was also working, also in the finance industry. I'm also busy working with the three kids. And so we'll find ourselves, let's say on the weekends, if someone moved out, then I'll be on Craigslist posting who wants to rent this apartment, or then my husband and I sometimes would tag team and either order the appliances, paint whatever needs to be painted. Anytime someone needs something to in the property, right? Like something breaks, then of course they're calling us. We didn't have a property management for these units because they were so small, which also means that they can't really afford, right? That, let's say, other level of property manager. I mean,
Mhm.
if we hired someone like that, I would have eaten the profits. And it's almost like, why are we keeping this property? So yeah, it was tough for us. And so one of the reasons why we moved to multifamily was to scale. Because with multifamily, we realized that, hey, you know what? We're never going to own, let's say, 100 separate houses. That's like brain damage for us. Or
Right.
at least back then, we didn't know how to do that, efficiently and
Yeah.
effectively. And so we started looking into multifamily because we said that, well, this, at least it's in one, big parcel of land, but they're all right next to each other. 100 units, let's say, or 200 units, they're all in the same building. And I
Sure.
felt like it has more efficiency, it has more scale to it.
So walk us through as you started looking at multifamily. What were some of the first steps you took? I mean, I know you read Rich Dad Poor Dad, which is a basic for any investing, right? Of real estate, et cetera. But where did you start? What did you do once you said, hey, we got to grow, we got to scale?
Yes. So when we moved to Houston, my husband and I didn't have a job, didn't have a house. We were
Oh,
just like, we're going to move. And of course, we had savings and we were both marketable. But it was really more of we just wanted to stop paying state income taxes. We wanted to live somewhere where it's better weather. And we just
mhm.
felt that, my daughter, since she was, I think, incoming eighth grade at that time, I said, now is the time to move. So we really just moved. So when we landed here, I started applying for CFO roles, right? There were some that were promising, but the more I looked at it, the more that it felt like it's another job, right? It didn't really give me that flexibility. We even looked at businesses, franchises, HR companies, staffing agencies, printing companies, restaurants. I mean, you name it, gym, we looked at it. And I was always going back to that limitation of scale. Like, this is going to be one location. How am I really going to be able to do this, in scale? And so, good thing that my sister, right, Angelica, so she's an architect. She owns her own firm. She's already built and designed about 20,000 multifamily
Wow.
units, mostly here in Texas. She lives here in Cyprus. We're neighbors. Good thing that at that time she was like, why don't you do marketing for me first? Right. She was like, can I do a little bit of business development with her? I was like, sure. Right. Because I wasn't employed. I wasn't doing anything. And I didn't even know that she was in multifamily. All I knew was she was an architect and she owned her company. I had no idea what her business was or the scope of her business. But anyway, I just said, you know what? If I'm going to do something multifamily, I probably should start looking into what's happening here in Houston. So usually I wake up early. So it was like like a light bulb in my head. I said, maybe I should attend a conference for multifamily in Houston. Lo and behold, the following day, this was me in bed, still, right? I Googled it and I found that there's this event at Briar's Club, which was a smaller, it's like Red News, which is a magazine, right? Here here in our market. And they were putting a 1-day event for multifamily Houston investing. And then the lenders are going to be there, the brokers were there, the investors were there, and so was some of these syndicators or operators. So I went there, and the rest was history. I mean, I was hooked on the conferences because I was like, I have an executive MBA from NYU, so that really helped. Because sitting in there, they were talking about cap rates and just how the market's shifting. I was like, this is a no-brainer. I was like, how can people really lose capital, right? Because again, my comparison was only on the stock market. I was
Yeah.
like, this tangible. So again, as an accountant, I was thinking this is a tangible asset. The building is right there, so at least I can see it, right? I only did value add for the first, 2,000 or so units, and so that's how I really got started. Was just that first event, and I said, you know what, this is something promising. Like everything they're saying is making sense. People are moving to Texas. I'm already here in Houston, and so I just continued to pursue that opportunity.
And so that involved, I'm sure, going to other networking events, other conferences. Did you get a mentor? Did you take any formal classes, or was that even needed?
Yes. So even for me, because again, I was new to the state, right? I don't want to pretend like I knew it all, right? Because I didn't. I had no connections whatsoever. I really had to start from scratch. But I gave myself 1 year. So I said, if I'm not going to go back to my CFO role, I'm going to give this thing 1 year. I'm going to give it my all. And if it still doesn't work, I could always go back, right? So that was my fallback plan. But of course, it worked. And how did I make it work? Was really through mentorships, joining different groups. I must have spent, I mean, at this point, right, 3.5 years in, I think I've spent more than $100,000 just because, one group's 40 grand, one group is 30 grand,
Right.
some
Yeah.
reviews. So, and I value education a lot, right? Not just because, I didn't want to make mistakes, right? As much as possible. I want to learn from people that's already made the mistakes.
Mm.
I felt that I had that timeline, right? So I was paying for speed. I wanted to make sure that I could go ahead, implement as fast as I can, also because it's a market cycle. So I figured, all right, well, if I get it now versus I get it 3 years later, because I was just like watching on the sidelines,
Right.
that was taking me longer. It's a different environment if I had started just now and started learning this versus me starting 3 years ago. I think I've already learned from that market. So I think it's important for investors to educate themselves because at the end of the day, it's information, right? We're just acting on information. I mean, nothing is perfect, nothing's going to be guaranteed, even in this world of investing, but it's finding out where are the best locations, who are the best partners, what's going to be my competitive advantage to the market, right? Because there's a lot of other people that are also investing. So why would, let's say, they invest with me, or why would we invest in these deals? So I felt like I had to really learn all of that during the first few years, to really, because again, we're handling a lot of millions of dollars in these transactions. It's not like you lose $1,000 and you're fine. I mean, we're talking about people's retirement money here. So yes, we had to act, diligently and do our own due diligence and learn, right, from those that's already gone before us.
Agree. And along the way, did you have a significant challenge or anything that as you got started, you're like, well, how do I jump into my first partnership? Or how do I, decide which market? What was your challenge in the beginning before you bought or invested or partnered on that first deal?
Yeah, well, I wasn't sure who else was going to invest in this because, again, I didn't know anyone else that was investing in it. So, full disclaimer, my sister, even though she's built all these new development with developers, she's never once invested in these deals. I
Mm,
started investing passively first, right? And then later on, she became my investor. So for me, it was really the biggest challenge was, okay, have I learned what I could learn, but really taking that first leap? It
mm,
required courage. It
right.
required partnering with people, asking them the right questions, right? So I felt like I could make an informed decision. But that was really the biggest hurdle was, okay, how do I compare this investment to, let's say, my other options? Well, what else do I have at that time? I could park my money in the bank. I could still continue using 401k, IRA, and invest in all these places. But I've seen the returns because I've tracked it for the last, 15, 20 years, and it's, let's say, 10 to 11%, right? Versus what I could have gotten in, let's say, multifamily. So I was like, well, I don't have to invest all of it now. I could just start investing portions of it and learn from these different groups. So that's how I got started, was just really learning it, make an informed decision, have the courage to know that, you know what, I'm not going to have it all perfect, but I'll be able to act on the information I've gotten and at least get in the game. I'm not the type of person that would just sit on the sidelines for a long time because then I feel like I'm not learning much, right?
Right.
Yeah, I did this for like 3, 4 months. And then after that, I was all in. I was a passive investor, finished all of that up within 3 months. And within the following month, I was asked to be a general partner in one
Mm,
of the deals. I didn't even feel like at that time, I didn't even feel like I was ready because it's
mhm.
not like I started warming up my market and talked to my friends and family. "Well, do you want to invest?" Like I had no clue. But I just knew if it's good enough for me, I've done my due diligence and I was going to invest in this deal. All I'm doing is sharing with people that, hey, do you want to invest in this deal as well?
Sure. So your first passive investment, how many units?
So,
Um,
mhm.
and where was it? How much did you invest? And there's a reason I'm asking you that, and I'll follow up with it in a little
Yeah.
bit.
So, first investments right here in Houston. I don't want to go far, right? I was like,
Yeah.
let me stay here and I can check the property. This one is 288 units in North
Okay.
Houston. So now we're refinancing it, right? Because it's been 3+ years.
Right.
And I invested
Fantastic.
$50,000 for that one.
How much?
$50,000 for the
Okay.
first one. Again, I was just like testing, okay, let me invest here, let me
Right.
invest there.
Right.
Especially
And
because that's my IRA money, right? So I wanted to invest my IRA money in someone else's deal, and then later on my own, cash and other assets that are not retirement related, I can invest in my own deals as a general partner.
so before you invested 50,000, think back a year or two before that. Did you think you had to have millions of dollars to invest?
Well, I didn't even know I could invest in deals like this. So it wasn't even an option. And then I was like, it's only $50,000. So
Right.
I felt like the entry point was better, right? It wasn't like I need millions again to
Sure.
be a co-owner in some of these apartments. So it was really a no-brainer for me, knowing what the stock markets were doing back then. I mean, even now, right?
Yeah.
Um, and I think it's going to be worse now with all the tariffs. So
Yeah.
absolutely, I was always looking for options, right? I didn't want all my funds to be tied up in one vehicle or asset class or, let's say back in stocks.
That diversification word, right? Because I think a lot of times that's what your financial advisor tells you first is, I'm gonna put you into a diversified portfolio. A lot of times they mean different stocks, different bonds, and a lot of times they're not offering alternative investments because it's not in their wheelhouse. And so those of us that do invest go outside of that world and look for these opportunities and educate ourselves on it. So good for you for doing that and taking action. I think that's the biggest step for any investor is taking that first step based on homework, based on education, based on knowing who you're partnering with. And so you mentioned that your second transaction or your second opportunity was as a co-general partner. So tell us about that experience, how you found it or how they found you, and how you went through your due diligence process to decide if that was something that you and your investors would be interested in.
Yeah, so I was networking in different events, right? So I was attending an event in Dallas, and I think that's how we first met. So it was a
Yes.
conference, and I met another guy that was also CFO, MBA from Canada. We were getting coffee, we just exchanged cars. We didn't sign up for that mentorship program, but we just said, hey, you know what, we're going to continue to to talk and just be an accountable partner, right, for each other. And so that's what we did. So every few weeks, I would call him and just be like, "What are you working on? You know, like, did you see anything else that we could potentially do?" Because we thought that we could both underwrite, right? Because that was our background, but there weren't really a lot of deals during that time frame. And so finally, he was the one who brought me the deal. He was like, "Hey, this group is looking for more general partners." So he was, let's say, there's 5 or 6 people. Let's say he's the fifth, I'm the sixth, right? So we were like the last two that were brought in that group. But because of his connections, he's known this group already for quite some time. This is the one in Sugarland, which I think he had invested passively in. Yeah, so that was my first general partnership. So for my due diligence, because I was the newest kid on the block, again, I felt like I wasn't ready, but I knew the people that were playing, right? And they were all more experienced than me. That was one. Secondly, I liked the, so I did my due diligence, started asking the people I met right here in Houston, hey, have you done any passive investments with them? Have you become a co-general partner with them? And all the reports were great, right? I mean, these are people that's already worked with them for the last few years. The other thing I looked at was the location. As soon as we finished the conversation, I drove straight there, even though it's already closed. So this
Mhm.
is Sugarland. I live in Cyprus. So it's like, at that time, like an hour just to drive there because of rush hour traffic. But I was just, again, all in. I was checking the boxes, right? If they say drive a property, and I started talking to the tenants there. And then I realized that the school was right next to it, or I mean, there's a bus stop that stops in our apartment complex to bring them to the school. I like the location. This was like a 2008 build property. So again, it's nice, right?
Mhm.
It's 200. I like to think 278 units. I think was this property. So it's not small. It's not something I normally would have done by myself.
Mhm.
So I figured, you know what, for my first general partnership deal, I want to work with the best teams, right? So because when I work with the best teams, my investors overall will get better, not just returns, but also experience. And then also for me, I feel like I'm learning from the best.
Mhm. Great. So you've partnered with folks, you've partnered with us, which we appreciate so much. But how would you describe your role in your business as uh, an investor, as a co-GP? Describe your day to day, because I think sometimes people have this illusion of what it is, either oh my gosh, you're gonna work a lot of hours, or that's all you work? I mean, I think there's, imaginations of what it really is. So tell us about that.
Yeah. So what I like about what we do now is that there's so much flexibility, meaning I can take on as many projects as I want. I want to do 10 projects this year, I can. Or if I want to do just, let's say, one a quarter, I can as well. Now it's just a matter of size. So again, when I got started, I was an investor, right? And then in that next few deals, I've done 8 deals at this point. 5 of them were general partnerships, so there's some like asset management responsibility. But for the most part, I've also done what we call funds, right? So I've become a fund manager. Same thing with what we've done with REIT, right? But those two were funds, which means now my day to day is slightly different than if I were just, let's say, a general partner. So when it's a fund, then yes, now I'm responsible for sending out the newsletters, doing the distributions, right now, making sure that the K1s are out, fielding all of the questions from the investors. So again, I think what it's good about it is I determine how much time I want to put in it. And now what I'm doing is I don't want to work in 10 different projects and let's say bring in a million each, right? I'd rather work in one project and bring 10 million in one project. So now I'm more selective. Also, because throughout the years, I was able to see, the ups and downs within the last 3 years, right? And there were a lot more downs during that
Mm,
time frame. So I think it's crucial to partner with someone like, for example, REAP, right? Because you're vertically integrated, you have property management, you have construction team, you have fantastic family that's working in the business, right? So there's truly skin in the game. You're the only KP, let's say for most of the deals, key
right.
principal, which means you're signing on the loan. So it's really your name on these
Mm,
properties. So I think that's important for people that are, looking to get into their first deals. You got to align with people that have been there, done it, not just for the last 3 year cycle or even 5 years. Like
right.
one of the things I love about REAP is they've been at this for more than a decade, which means they've gone through all the cycles. They've seen it, they've exited. It's not just a matter of, oh, you know what, we've exited these deals. And then if you really look at when they exited it, they exited during COVID. So
Right.
of course it's a peak. Of course it's like all the numbers are rosy. So I think
Right.
it's good to partner with someone that's tested, throughout the real estate cycle.
Yeah, I think that is important. And my husband and I invest passively also. IRA money also. I did a little test. I took half of what I took from my Bank of America 401k and left it in traditional stocks, bonds, etc.
Mhm.
And then I took the other half and put it into multifamily. And the return on the traditional portfolio was 11%. And the
Yeah.
return on, and this was just two deals that I invested in that sold, was almost 25%. So
Wow.
11 versus 25. It was just, I mean, I knew it because this is what we do day in and day out, but it was nice to see it in on paper. And these were deals that I didn't run, I didn't, buy, I invested in, but I chose which ones to invest in. And I think more and more people are looking for the alternative investment. I mean, the stock market, as you know, has been on a super high. And now with all the tariff announcements, it's, seeing volatility. And I've always felt like it had a lot of volatility, which is why we did multifamily. Um, in 2008, I saw a lot of friends that saw
Mm.
their portfolios decline 30 to 40%. And because I had been a banker, the stuff we put it in was very conservative. So we didn't experience that, but I thought, what if we had? What if we had seen a 30% decline? And sometimes people react and sell, which they tell you not to sell. They say, hold on, till the market stabilizes. And that's the traditional stuff. And I just, I've watched multifamily over these years and I don't worry about it. Maybe it's because I'm managing them because I know what happens every day, but I'm not worried about the volatility because it has been resilient,
That's a
multifamily.
very good point, especially now, right? Because
Yeah.
again, with these tariffs, someone has to eat those costs. So either
Right.
the business owners would have to just suck it up, right? And then make less profits. But if they're publicly traded, that also affects the investors because now their
Yes,
valuation is going to go down. Or if not that, they're going to pass it to the consumers. So same thing, either way, no one wins.
I
And
agree.
that's why I've already moved all of my wealth personally for me.
Mhm.
My husband still works at Merrill Lynch, he has some portfolio there. But for me personally, my entire wealth right now is in asset classes that I know I can control, right? They're private, which means a lot of these public, like all of a sudden tariffs, right? You have no control over that. So if
Yeah,
your money's right there in stock market, it's going to go up and down, up and down.
right.
So I wanted to be knowledgeable in an industry where I felt like, okay, I know where the location is, I know who the operators are, I know the business plan, and it's very simple. It's just
Yeah,
really increase the occupancy, right? Decrease
yeah,
expenses, right? And then market it, right, in a way that you're not just timing the market because it's hard to time the market, but there's certain indicators
sure.
for us to know whether it's time to sell or time to hold it for some more years. So to me, multifamily was simpler. And it's very hard to lose capital. What do I mean by that? Again, this is a physical asset. It's not like all of a sudden the company's going to fold. There are 200 families living here. And let's just go back even, let's say COVID, right? Which let's say is the worst, in our history, right? At least for the last 50 or so years, probably the worst that's happened in the world. But even during that time frame, COVID, well, with COVID, people weren't moving out of, let's say, their apartments or their houses. Now they can go to their work, their jobs. Now they're working from home. or their apartments. So it's like it's such an insulated asset class. And then also from the government's perspective, what's the biggest cry right now, right? The problem is there's not enough housing. People are
Yeah.
not moving from their houses, right? Or it's harder for them to buy a new house as well. So what are they doing? They're staying in an apartment. They're looking for more apartments. And I think I read it somewhere. I think we have 3 million apartment or housing that's needed, within the next few years. So I like to be in a business where I feel like there's some type of advantage, there's some type of subsidy. It's such a need. At the end of the day, everyone needs a roof over their head. And if you're in an apartment, I think you're definitely ahead.
I agree. When the pandemic happened and we, you know, heard that everybody was gonna, businesses were shutting down and people were gonna stay home. We didn't know how long. And as a business owner, you immediately start to think, how is that going to affect me?
Mhm.
What are people going to pay their rent? What's going to happen? Because, we had 28 properties at that time. And, I think the incredible thing is one, the government stepped in to
Mhm.
protect people's housing. And so we would literally fill out the assistance applications for the tenants and deliver them to their door.
Right.
Here it is. There's nothing you need to do except verify this information and sign it. And what we experienced was we had a 10% growth in revenue in that period of time. And our occupancy grew. And
Mhm.
so you're right. It was probably the biggest proof of one of these unknown events that happens, in our economy or in our country, actually the world.
Yeah.
How does it affect a business? We saw it firsthand, and you're right. It proved to us how resilient this in multifamily industry is because people have to have a place to live. And across the US, I know in our markets, all of them, over 50% of the households in San Antonio, Houston, Austin rent.
Mhm.
So if you're having growth, which we are in Texas, as you know, our
Mhm.
our top 4 markets are in the top 10 in growth. So if you have, call it 1 million people coming into, let's say, San Antonio, which is what we're expecting by 2030, 50% of them need a rental place.
Yeah.
So that alone tells you, okay, great. I'm in the right business to provide that need, to
Yeah.
meet that need. And so I agree with you completely that it's a good place to be. We don't invest in other asset classes, although there's a lot of great ones. I will say there are. We've just chosen to be really, really focused so that we could gain expertise in what we're doing. And I think, what we hear from our investors is that they appreciate that a lot. What are you hearing from investors today about multifamily?
I think you still have a good group that likes multifamily for the reasons that we just mentioned, right? Yes, some people would like to start diversifying because, for example, I live in Houston. All
Yeah.
of my properties are Houston and San Antonio, right?
Hmm.
So if I can find something, let's say in Dallas, that'll be great. Austin right now, maybe a little bit more overpriced, but it's just good to start spreading that. Would I start investing outside of Texas? Probably not, at least at this point, just because we have so many opportunities. And I feel like for you and I who are right here where the action is, yeah, we're getting, I think that's our competitive advantage. We're local, which means all the relationships are local, right? From the brokers, the lenders, from the
Yes.
investors, because they also want to invest somewhere here versus, let's say, me coming into the market and just tell them, I have a deal in Ohio or I have a deal in, somewhere else where they're like, oh, I don't know if I want to invest in that. People would still prefer, right? Distribution. So I think some people, especially now that I have more than 100 investors personally, right? That's
Nice.
invested with me. So just even with that 100 people, some of them are retirees. So yes, they're counting not just on the equity side, but they're looking for cash flowing options. So I think
Mhm.
it's good to even for example, for some of the operators like yourselves, right? We started having like a debt fund. So I think that's helpful for those that are looking for that immediate, quarterly distribution or monthly distribution versus just banking it on the equity. But and again, this is me coming in because I started 2022, right? Yes, I don't have any deals that's gone full cycle, but really our deals right now are doing well,
Mhm.
right? I guess it's different if, let's say, someone had started investing 2019, 2021, and where those deals are right now. I think it's a different conversation depending on those investors that may have been affected, with capital calls, or not just pausing the distributions, but maybe losing capital, right? So there's a lot that's happened within the last few years, and that's why partnering with really good operators that know what they're doing is key to anyone's success.
Yeah.
Whether you're a passive investor, general partner, co-general partner, or a fund manager, you gotta align with the right people so that these investments are safer, right? Because it's always risk and reward. You're just hedging that, and you don't have all the decks all in one place, or you got to just make that decision based on what you already know. So yeah, I think investors right now, definitely, they still want to diversify. So it's not all, let's say, Houston, we have tornadoes, we could also have hurricanes. So I want to mix it up. Um, but I think expertise is only going to come with being in that market, right? Which I think is what REPA's done too. Like, you guys are experts here because these are your markets. So I think it's, everyone's expansion is going to be different. Um, I think now is the time, right? Since not a lot of players, I think the last 2, 3 years have weeded out a lot of groups,
Yeah.
and they're not going to be able to bounce back, unfortunately. And that's why whoever's still investing right now, whoever's able to bring capital right now, whoever are closing on the deals and not retrading them, I think are the groups that are stronger, right? For a reason, like they're left standing for a reason. They're good groups.
Yeah, that's a good point, because there were a lot of folks that entered in the heyday of the market, when the cost of capital, your loans were so low that it was easy to make some deals make sense. But as you and I know, buying them well is great, but you have to operate them to get that value up so that you can sell for and gain that appreciation. So you're exactly right. I think the market. They always say the market corrects itself,
Yeah.
and the players in the market. And I think we have seen that. You know, it's not always good to see it, but it is a factor of the market, I think. So you're exactly right. We just started looking at Dallas Fort Worth. We've been looking for a year or so, but I really believe pricing today is probably more advantageous to go to that market today. So we're aggressively looking for things in that market. But to your point, we underwrote 154 properties last year, and
Wow.
we bought two.
Yeah.
And the year before, we underwrote 254 and bought four.
Mm.
And so some people may say, wow, that's a lot of work, not for a lot of return, but for us it is, because those were the ones that made sense. And real estate, as you know, is a long-term game. We're going to hold these assets for, call it 3, 5 years. So it's got to have staying power, so that we can get to the point where it makes the most sense to sell or refinance. So I think it's to your point, a good market. I think we're at the bottom or close to the bottom of the market in terms of pricing. So I think it's good to be here where it's going to do nothing but go up. So that's fun to see. Well, we've spent a lot of great time talking about all your great advice. I mean, such a short amount of time. How many units?
2,800 as a GP, as an LP, right? And 1,800 units as a GP/fund manager.
Amazing. That is a true testament to taking the bull by the horns, as they say, and making things happen. So, as we wrap up, what advice would you offer to another woman who is looking at starting her real estate investing journey in multifamily?
I'd say go for it. I think most women, right, we doubt ourselves, we're like, oh, can people really do it? We have a lot of questions, but I would say write it down, right? Start writing the questions down and start putting the answers as well, because the answers are right there. You have these podcasts, you have books, you have conferences, you have people you can talk to, right? And qualify that information so that you can make an informed decision. But really, I think now is the time to invest. I wish I knew this when I was in my 20s. I felt like just 20 plus years, wasted, playing in the stock market. I call it playing, not even investing, because you gain, you lose, you gain, you lose. So there's definitely a reason why a lot of people have started to gravitate towards these types of investments, because you can still be an executive, a businesswoman, a professional somewhere else, and let your money work for you. So I think that's what's great is you have these opportunities, you have these options, but it's information I think that's keeping most people away from it. Because again, I didn't know this even in New York, right? Even when I was doing my MBA, none of us knew this. So now you can be that person that not only would know it, but would benefit from it. And then later on, you can feel free to share it with the rest of your peers, because this is working for a lot of people. I've seen time and time again. If you invest in the right markets, if you invest in the right people, right asset class, I mean, the only way it's going to go is up. Why? Because they're not manufacturing more land. Land is scarce. This is it. Stocks, you're going to have more companies. I mean, before you know it, 5 years from now, there'll be another AI, right? That's what they're saying. AI is going to replace all the jobs. So there's going to be a shift in just the economy, the businesses that are still running right now. But land, they can't make more of it. And as far as I know, even if they can automate the construction of these buildings, let's say on the new development side for multifamily, at the end of the day, people still need a place to live in. And that's going to be where you come in, because you can take advantage of this, not just as a spectator. Now you're participating in all of the benefits, such as cash flow, right? You have the equity as well, right? Because now you're a co-owner, and then you get savings on your taxes on the depreciation side. So it's like, for me, it was a no-brainer. There's no really, like, there's got to be something massive, for me to lose capital. But even COVID, they didn't make people lose capital. If anything, they gained the most value at that time. So definitely do your due diligence and, partner with someone like REAP, that has outstanding quality control. That's why they underwrite 150, 250, and close to 2 to 4 properties for a reason, because they only bring out the best in the market. They cherry pick the 2 or 4 properties, and that's when they go out in the market. So don't be a spectator, start playing in the field, and you won't regret it.
That's phenomenal advice. Wrapping up, is there a book you would recommend for people to read?
I mean, I did read Rich Dad Poor Dad if they haven't read that yet. Back then when I was starting, I did read a few books, but I think now that's outdated, just because, again, that was written 2015, 2016, and market has already changed. I am writing a book, actually. It's called Apartment Investing, Your Fast Track to Wealth. It's going to come out by next month. And that's really all my experiences within the last 3 years, as a female investor, living right here in Texas. And I've seen, how this market has evolved. So definitely pick up that book once it's out.
Great. Yeah, we just released ours. It's right behind me. Leap of Faith. And so that's been out now a month or so, I guess. So it's fun to write them. And so congrats to you on writing your book.
I gotta read your book.
What's that?
Yeah, I gotta read your book.
Yeah. It's not designed to be real technical in nature, from underwriting and all of that, but more of kind of the journey as an investor, how to find partners, how to understand the business. So definitely, we'll send you a copy so that you have it. Yes. So, well, thank you so much, Anjou, for sharing your wisdom and your time with us today. I know that this is going to impact women who listen to this podcast. And I think the biggest thing is taking action, as you said. Get started now. Don't wait. Do your homework and answer those questions that you have and move forward. So thank you again, Anjou. And for those of you watching us, thank you for joining us on another episode of Empowered Investing with Leading Ladies. Have a great day.
Thank you.
Thank you.